The views and opinions of this program are those of the host, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Today's episode of Market Talk is brought to you by Growmark FS. Keeping up with the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic, grain, and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. Well, I'm starting to feel like a bit of a broken record, but more outside market volatility seen on the day Wednesday, and that spilled over into grains and livestock once again as well. There is so much for us to discuss, and here to try and help us make sense of it all, we welcome in Mike Zuzolo of Global Commodity Analytics joining us here today. Mike, great to have you on here this week once again, and as I mentioned, I'm starting to sound like a broken record. Another day of volatile markets and this outside market trade, everything from the stock market to the dollar surging to crude oil breaking sharply lower. There was just so much out there to really take a look at and sink our teeth into today.
Ian, it's nice that you started that way. Great to be with you again, Jesse. We've talked a lot about the WTI crude dollar relationship and how typically when the dollar goes down and the crude goes up, and they do typically move in opposite directions, that's usually inflationary. And so when the dollar moves up and the crude moves down, that is a signal. It's sending a signal at least to the markets for right now that we are entering into more of a deflationary mindset. And as we look at this weekly crude oil chart, we can see very clearly, as I've designed the trend line, the channel that goes lower by the two purple hash bars, hash lines. You see that downward channel. Those you had lower lows and lower highs until we saw China break free of its zero COVID strategy. Well, now with this banking crisis and the issues with the energy markets starting to feel like we're going to go into a recession, and that's that deflationary mindset. I think it's signaling recession. The bond market is signaling that the Federal Reserve will not only not raise anymore, they'll actually cut, and maybe cut as much as 1 percentage point before the end of this year because of what's happening in the bond markets and what's happening in the banking sector and what those bond markets have done to the financial sector. And it's not a surprise that these bond markets, by rallying so sharply in the yield, by the bonds going lower, did what they did to the banks and put them underwater on paper, especially given that the net assets, when you figure in the deposits in some of these banks, when they got pulled out, that quickly put them underwater. And many people have asked me whether this smells of 2008, and it is starting to feel and smell more like 2008 because we've not only had two banks here in the United States go under, but now we're hearing Credit Suisse may be going under as well. It closed at a record low today. It was asking, and this is reported by Bloomberg and the Financial Times, it was asking the Swiss National Bank for a, quote, help or lifeline, which means a bailout. And so this crude oil market is getting serious in terms of breaking lower now out of the sideways trading band. And if we reestablish that zero COVID channel to the downside, then we could open ourselves up to a 50 or even a sub $50 crude oil price here in the not too distant future. And that would probably create some real headwinds in the commodity sector, including ag. And one last thing is Bloomberg was reporting through one of the big banks that they had talked to today that there were algo trading factors beating into the crude oil, what they would call delta hedging. I won't go into detail on that, but it's essentially utilizing options around the futures position to try and insulate you from short-term losses. And when you unwind a delta hedge, you're typically going to unwind the options and keep the futures. And that in part was why we had such a strong day lower in the crude oil market. So we know the funds are in there.
Well, a couple things I want to unpack there. I know we're going to get to the impact on grains here in a second. I definitely think crude oil, the move lower, impacting the soy markets, especially quarter wheat, had some of their own fundamentals that helped them at least stay fairly quiet to slightly higher. But You mentioned in there the markets maybe a comparison to 2008, and I wonder if the Fed starts cutting interest rates here instead of trying to tame, going up more and trying to tame inflation and get ahead of it. Could we set ourselves up maybe not for a 2008 scenario, but maybe an 80s scenario here? What's your thoughts with that? I mean, there's so much worry out there with the banking system and everything going on with inflation. Expand upon that thought a little bit for me, Mike, if you can.
Yeah, and I think that question, I think we want to overlay the idea that the worry has been in the demand side all year long, except for last year at this time when we had the Ukraine war start. But everything has been about demand when it comes to commodities. The equities market's almost the exact opposite. They can't see anything but higher price action, even through what was going on with the Federal Reserve raising rates. And so I actually think the financial markets are balancing themselves out better now. They're not as exuberant. They know that the Federal Reserve is serious, but to the commodity markets, that's really hurt us. And so you can make an argument where you could have a interest rate price action where the Fed's trying to keep it contained and knock it back, but the funding, the lending costs of some of these banks already in pretty much the whole banking industry here in the world now, the funding costs are getting higher and higher so that they have to go out and sell shares or they have to figure out a way to get more liquidity. And so you really are kind of walking yourselves into a real question mark as far as a black hole of what this market could do. And I think that's what feels like 2008 all over again. And then you throw on top of that the increasing likelihood that we will see a bigger war in Ukraine. And you have to start thinking about that as well, as far as not just a recession, but maybe even a depression. And this, to me, Jesse, continues to kind of walk us slowly towards the way life was right before World War I. And that was exuberance followed by a strange impact of a pandemic from, the 1918 time period, post World War I. All these things are coming into play here, I think. And what I see happening is, as far as why it's before World War I possibly, is because no one really wanted to believe that globalization would end. And I think if I add all this stuff up and put your question on top of it, it spells real trouble for globalization. And I think that's really, at the end of the day, what's going to be so difficult in the commodity markets. And if you can sense by my answer me trying to feel myself around, well, that's because it's a historic thing we're going through. And that's exactly why I recommended getting puts underneath me in new crop beans. I'm not going to take a loss more than 13.45 on November beans because we needed to stay above that, even with the bull spreads, even with whatever you want to throw out there that's bullish. We've made new 2023 lows in November soybeans today. And I think that's really important. If you're going to do something about what the uncertainty we're talking about, I think you stick with going after the gross revenue per acre, and that's in soybeans right now.
Let's talk a little bit more about that Nov bean December corn spread. And, your point, making those new lows in November beans, looking at D's corn down a little bit today, some intermarket spreading there in the corn trade with the China corn sales there 2 days in a row, it looked like. But walk us through this chart. I'll pull it up on the video feed here and just talk a little bit more about this spread between D's corn, November beans, Mike.
Well, it has to be thought about in context of the acreage report coming out here at the end of the month. So we're about a week and a half away from it. And we notice that this is a November bean price divided by December corn. And so we got up, upwards of 2 weeks ago, upwards of 2.46 premium in November beans. So November beans were 2.46 times the price of December corn. When you see that and you see that big high that we just made, and you go back and that was the highest high since the third quarter of 2021, we were buying bean acres at that point. And that's especially important because I think the USDA uses this ratio quite frequently in their March acreage estimates because it helps understand where the profitability is for producers. So we were buying bean acres up until the WASDE report, and then something really changed, and that was the fundamentals. And the fundamentals did not point to a lower Brazilian bean crop enough to offset to make it bad for the lower Argentine crop. And so the Brazilian bean production was well in excess of what the Argentine cut was. And along with that, this week, we're now seeing China buy 2 days in a row large quantities of U.S. corn. Well, and that is because Brazil has, at this time of year, typically shifts from corn exports to beans to get the beans out of the port, out of the country. And they have to do that this year because of the capacity issues, Jesse. So when you see this type of a reversal and you're now back down below 2.39, which is kind of the go no go gauge of a neutral mindset typically, and you're now starting to get back into wanting to buy corn acres by after today's break, you've got a situation here going into the report that fundamentally it makes sense, both from a standpoint of the wheat crude oil markets we talked about and the corn purchasing by China, that we really probably do need to come back in and put some premium in that ratio in favor of corn, but that's being done primarily through letting the air out of the soybeans.
We are having a conversation here today with Mike Zuzolo of Global Commodity Analytics. Mike, one more thought on the corn sales to China. I know we've heard these rumors for a couple weeks now. Do you think this is the confirmation of some of those rumors that have been in the trade? Do you think we could see more, as you alluded to? Brazil's moving to soybean shipments. U.S. corn seems like it's really the only game in town here at this point.
Yeah, I really do. I think the only thing standing in our way is the Ukrainian situation. And if we do go ratchet that up and China takes a stake in supporting Russia, we saw today that Syria is taking a stake in supporting Russia. And if China steps in and supports Russia verbally or very frontally, in the marketplace, then we can expect the United States to slap sanctions on China. And then we unwind everything good that we've probably built up here with these two purchases of U.S. corn going to China. But supply demand wise, Jesse, I don't think that the Brazilians are going to be in the market until the late summer, mid to late summer. And that's if they have a good second crop corn. And that's a big if right now.
Let's talk a little more since we're on the topic of China. Another chart I'll pull up on the video feed looking at soy meal, looking at futures in China, looking at futures in the US. This meal market's been so red hot for so long, Mike, and now, with the break in beans, we're off the highs here in meal. What's your thoughts with what we're seeing there right now?
This is quite a disappointment in the price action, excuse me, because if you go back to 2012, when we had these kind of prices in China before this year, we see that the United States price really went up and tried to stretch its legs towards the Chinese price and got upwards of $550 plus per ton, while the Chinese price kept going higher. But what we've seen this time around, and I think it's a really, I guess figuratively speaking, Jesse, I'd put this as one of the nails in the coffin of the soy meal market, is that the Chinese meal prices have just collapsed. And they've gone from over $600 a ton to $492 as of today. What did that? Well, we found out today that Africa's swine fever is very much in the Chinese hog mix and herd. And we've also got the meal market with the margins now still running negative in the big areas where they crush a lot of beans in China. So this is one of the two big issues that we were using to stay relatively strong in the beans, especially compared to corn and wheat, hoping for even higher prices. The second thing that I didn't put a chart up today that I'll give to the clients and subscribers tonight is the Brazilian currency. We made a new multi-week low in the Brazilian currency against the US dollar. The price of Brazilian beans coming out of Paranagua are already about $35 to $40 a ton cheaper than our Gulf price, and probably half of that or 2/3 of that going out of the PNW. But the weakening Brazilian currency is only going to hurt us more. And so I think you've got several factors other than the bull spread in the soybeans, which is still very strong. Several factors that are starting to go away as far as what's kept this bean market rally going. And that, again, is a reason why I promised myself and promised the clients if we'd lose some of these fundamentals, we'd have to get covered up on these beans with the price they're at.
One quick stop in the wheat market real fast. I wonder, wheat, a little bit of strength on the day, even with the sharply higher US dollar. Is that tied to maybe some of the risk premium being put back in with the Ukraine situation, the grain deal, and whether or not we'll get it extended? What do you think about that?
Yeah, I think so. I think it was real impressive that the European wheat market was able to turn around and go higher again yet today. It hasn't gotten back to where it needs to be technically. The soft red wheat hasn't gotten back to where it needs to be technically, but they're really, really close. And what I'm continuing to hear, and I talked to a French news source yesterday, and I talked to another large news wire today. It seems to me the market and the news people in general really haven't bought into the idea that this could not be rolled into another 120-day extension, and they're starting to feel it, but they don't want to believe it. And I think that drone hit that the Russians did on the U.S. drone over the Black Sea was kind of a wake-up call, because as we've talked about before, everything I see on the chessboard would suggest that if Russia has this offensive going, Ukraine comes into a counteroffensive later this month, it's probably going to be in the Black Sea. And so it really doesn't make any sense for a 60-day extension from an insurance standpoint, from a freight standpoint. So it's essentially, I think, Russia trying to mess up the whole deal as they prepare for a bigger battle. And I think the trade's going to have to come to grips with that. And bottom lining it out, wheat is our best solution and our best hope to holding these grain markets together against these macro factors, and especially with hard red wheat conditions in Kansas, very poor to poor, jumping to 52%. It was 38% a year ago. So we're heading towards double the badness in this crop in the state of Kansas, and we remember how bad last year was.
Well, great thoughts. Let's segue to livestock. I want to give us a little bit of time here. Both cattle and hogs, we accelerated to the downside the last hour or so of trade on Wednesday in both cattle and hogs. Let's start, though, in the cattle market. One more chart I'll pull up on the video feed as we look at live cattle. What are you thinking here? What are we seeing? What was with some of that pressure? Was it all outside market related or something else today, Mike?
I think a great portion of it was, Jesse, but we were up there at that 166, 167 level in the fats, and we never could get a cash market established last week. We came in with a light cash trade on Tuesday night at 164 in the Southern Plains, down $1. And you combine that with this chart where you see, with the caught up commitment of traders report that we got last night, that the funds, indeed, the non-commercials net long position, are up there to levels not seen since 2019. And so they were really pushing this market hard. It wasn't all cash market related for the futures. And I think that's where we came back to earth. Now, having said that, look at where April futures are. They're at 161. Look at where June and August, they're almost identical in price at 156. So now all of a sudden, after this break, led in part, like you say, by the equities markets and the consumption fears because of that, we now have a discount in the futures market. So I will be pulling off hedges here by the end of this week, and I'll actually be looking for a place to probably buy into the August fats, assessing this as a correction, not a top. And that June and August fat cattle price being the exact same price doesn't make sense to me, especially if we tighten up these numbers like the cattle on feed report is suggesting, with placements only at an average 94%.
And the hog trade, you mentioned the African swine fever concerns in China. We saw pressure there as well. I wonder, maybe some of that playing into that hog market possibly, Mike. What's your thoughts there?
That's a little harder to explain. If you have China's domestic herd going down, you would think, if you were in the marketplace, that they would have to come to us and have to buy into more of our pork, but the exact opposite happened. So I'm wondering whether we're just not at a situation where we won't trust the fact that China will come in and buy our pork. And it was a pork and bean type trade today, where the pork, the hogs and the soybeans got hit the hardest, at least in the ag sector in percentage terms. And so I think there again, it's probably the funds and the length of the funds, or the fact that they want to go net short because of the U.S.-China trade tensions. But I was disappointed with hog price action today, Jesse, given that African swine fever news. So I'm going to see how we close the week out, but we could be heading towards our major lows again in lead month hogs if we're not careful.
Well, Mike, as we get close to wrapping things up here today, floor is yours. Final thoughts for us. Anything else you want to add or reiterate here today?
And I think the big thing to think about is please consider, looking at some of the analysis we do and stepping up your marketing, stepping up your risk assessment of what's going on, because it's a real critical time, whether you're in cattle or whether you're getting ready to plant row crops. I really think you want to elevate, as I always talk about, elevate your marketing, especially this time of year, and especially given what's going on in the outside markets, because these are historic markets and we may be on the cusp of deglobalization and we're slow walking ourselves into it. So this is not just a 1-year plan. This is a 3 and 5 year plan. So please consider getting a trial at globalcomresearch.com.
Well, Mike, thanks so much for the time as always. And again, you can find him globalcomresearch.com. That is com with 2 M's, globalcomresearch.com. Mike Zuzolo, thanks as always. Have a great week, sir. We'll talk to you next week.
Thank you, Jesse. Take care.
And that's going to do it for Market Talk here today. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.